Well, what a cracker start to 2012. We've got the US market up by 4.5%. Even Europe, with all of its problems, is up by nearly 3%. But the winner has been Asia, which is up by nearly 7.25% over January. The only problem is we're not sure that this is going to continue. Over the last week or two, I've been around and chatted to each of our CIOs, and it's been remarkable how they've come up with very similar takes for the coming year. They anticipate far more volatility. The problems of Europe, US growth, and whether China is going to achieve a hard landing or not are likely to continue to unsettle the market. And moreover, all of them leave the door open to the possibility that we still could get one more large sell-off. But there's also the possibility that Europe does solve its issues, that US growth is strong, and that China does come into a soft landing, in which case equity markets could rally. So this is a year in which we've got upside risk and downside risk. We can't afford to be out of the market, it seems, but again, we can't afford to be too aggressive. The other feature that our CIOs are concerned about is that they think, and on the good side, they do think that US growth is going to come in at around about 2.5%. So sluggish US growth is okay. But what is really interesting in our CIOs' views is this. Have a look at the last 2 points. They all see value. So if we see value there, it's a matter of the risk that we want to take on board. And that's what this year is about. Again, we're being paid to take on risk, but how much risk? And that's up to you to decide with your clients. Now, coming into 2012, one major thing has changed, and that is that the global liquidity is starting to rise again. You remember in 2008, global liquidity dried up very quickly. Then central banks came in and pumped money into the system. The stock markets rallied. But subsequently, until about the middle of last year, the growth in global liquidity started to slow down quite dramatically. In 2011, however, we've seen a turnaround, and that's quite clear in the chart here. This won't drive the stock markets higher, but what it does mean is that if sentiment improves, there is the liquidity there to fuel rallies. Now, what else has changed as we come into 2012? Well, the growth forecasts look pretty good. As you can see, even though we've had downgrades, the outstanding figures, the current consensus figures, all look pretty good. So we can't be too pessimistic about that. The one thing is that attitudes have hardened towards Europe, and it does look as though Europe is going to head into recession this year. From Asia's point of view, the direct exposure is not so great. Will that affect the stock markets? Undoubtedly. Will it affect the economies? Maybe not so much. The good news, though, is that these GDP growth figures are all feeding into higher sales. And I'll show you a chart that I've shown you many times before, where you can see sales, corporate sales, are actually rising, and particularly within Asia. Even in Europe, you can see there's been some easing of sales there, but it's not as bad as the economic and the crisis figures would suggest. That, of course, is very good news, because rising sales will help support rising profits. But there is one fly in the ointment, and that is our fund managers are still very much concerned over the level of profits forecasts. These have been very aggressive over the last year or so, and we have seen some very strong growth in profits, and we're not sure that that is actually going to continue. Yes, as you can see, we've seen some very big downgrades in the profits forecasts within Asia, and particularly within Europe, to a lesser degree, to a lesser extent in the US. We tend to believe the profits forecast now more than we did at the beginning of the year. But the general consensus is that they still could be a tad too high, which is going to unfold and work its way through over the next 6 months or so. So again, something to watch out for. But at the end of the day, it comes back down to valuations. Because if the stock markets and the bond markets have discounted all of this, then we can say, well, maybe we should be looking again at these asset classes. And if we look at the valuations, you can see that a picture really does start to unfold. When you look at Asia, Asian valuations are again not at, but they're certainly at the lower end of their valuations over the last decade or so. When you look at China, valuations there are towards the bottom of their 10-year range. If China comes in for a soft landing, valuations there are so low, we could see the stock market start to move quite quickly. But we have to wait and see. When we look at the US, we get a similar picture. And of course, when it comes to Europe, the European markets look extremely cheap or very attractive at the lower limits of the last 10 years. But are people going to go in there? Probably not at the moment, unless they're prepared to take on the risk. When it comes to bonds, we see a very similar picture. The bond markets are not as cheap as they were before a year or two ago, but they're still cheaper than they were before the crisis began. And the point is, not just in Asia, not just in the US, but also in Japan and even in Europe, companies seem to be in far better shape than they were before the crisis began. They've got rising profitability, they've got falling debt levels, and they've got rising cash. So dividend payments and coupon payments seem to be protected. So that's where we are as we head into 2012. We've had a very encouraging start, but we're not sure that the momentum is going to continue for the reasons mentioned. However, we firmly believe that investors are now being paid to take on risk. And so it's just a matter of what assets and what level of risk.